So we have some breaking news this morning. The unemployment rate came in. It was expected to come in at 4.3. It actually came in at 4.2, and the markets are doing fantastic. So we're going to talk today about how healthy the U.S. economy is, because this weekend, the country turns 250 years old. I don't know if you realize, but last week, I turned 61. I had to go in and get my cholesterol checked, my blood pressure, just to make sure everything was okay. So today we're going to take a deep dive into the United States. We're going to look at the GDP, the inflation, oil, the jobs reports, and give you a diagnosis of how healthy the U.S. economy is. So if you're watching this video, hopefully you're a homeowner, home buyer, trying to figure out, Dan, what really causes mortgage rates to move? Well, today you came to the right place. I'm going to explain to you guys why mortgage rates move, and I'm also at the end of this video going to give you my forecast when I'm advising my clients. And the reason why I do this is I'm actually a licensed mortgage loan officer in all 50 states as well as Puerto Rico. If you need some help with a mortgage, I'll let you know all my information at the end of this video. You're for these, so let's get to it. So here's what the bond market's telling us today, because each day when I come in, I like to start with the chart. If you're a stock person, you look at the Dow Jones. If you're a mortgage person, you look at this thing right over there here. It's called a mortgage bond. You see up at the top right there, it says an MBS. All you have to understand if you're watching this video is that number. If it's green, that's good news. It means mortgage rates are going to get a little bit better. The bigger the number, well, the bigger the adjustment. So today we're up 0.7, and it was starting the day down here, but we got that jobs report in, and it jumped all the way up to here. So what's really causing the markets to move right now? Well, let's get over to it. Here's what we're looking at for today. Stock futures gain as those chip stocks continue their rally, but a weak jobs report is actually easing pressures on rates. So here's what happened. The other day, there was a JOLT index that came in that says job openings and labor transfers. That shows the job market was fantastic, actually too good. And now they're saying, okay, the Federal Reserve saying, okay, inflation's too high, but the jobs market's too good. So what do? Well, we're not going to, cut rates. We're actually going to increase rates. I don't know if you know, there's some analysts out there that are saying the Fed's going to increase rates 3 times within the next year. So let's dive into the data. What does the Fed actually look at? And it's kind of the same thing that the markets look at as well. So the Federal Reserve, they control one rate. That's over through there. That's the federal funds rate. Basically, if you're one bank and you need money, you go to another bank and that's the rate you pay. Don't you wish we can get that rate? But here's what we want to focus in on. We want to focus in on inflation, and the Federal Reserve looks at the PCE, the personal consumption expenditure, and they look at the unemployment rate, and they also look at the GDP. Let's kind of go backwards. Okay, the GDP, it came in previously, its first reading was up 0.5, then it was revised to 1.6, and then it came in at 2.1. So the GDP of our country, I'm giving that a thumbs up. If you go to the jobs report, this number just came in minutes ago. The new unemployment number, down to 4.2. It went down. So that means, okay, the job market might be okay. Okay, but here's the problem, right over through here. This is the inflation number the Federal Reserve looks at. They monitor this thing. That's the personal consumption expenditure. They want this at 2. Well, it's at 4, and probably a little bit higher than that. But what is causing all this? Well, if you break it down, it's oil. Because this huge rally right through here, this is all caused by oil. The Federal Reserve came out, and even the markets are saying this. So let's get over to the economic calendar so I can explain to you kind of what is all going on, and then I'll show you what most likely is going to go on with interest rates, and I'm going to prove all those analysts are saying the mortgage rates are going up 3 times, or interest rates, or the Federal Reserve is going to increase rates 3 times. They're absolutely wrong. So here's the data we got for today. If you come in here, we got average hourly earnings month over month and year over year. Well, if you stayed on your job, you got a raise most likely of 3.5%. Now, here's what the reading says. It says the last reading was 3.4. Analysts said it was going to most likely increase to 3.5, and it did. Okay, but here's where the numbers get a little bit weird. You go down through here in initial jobless claims. Last reading was 216. They expected it to tick up a little bit, and it basically stayed at point. Here's the concern I have. Continued claims continues to stay over 1.8 million. Okay, that's a concern of mine, but the Fed also looks at the unemployment rate. So this is where it gets a little confusing. If you go down to the unemployment rate down through here, the last reading was 4.3. They said it was going to stay at 4.3. It actually dropped. So if you go through here, this is saying, okay, now we don't know if the jobs market's good, bad, what's going on. But this is painting a picture that the jobs market isn't as robust as a lot of people think, or isn't as bad as a lot of people think. So now it's saying, okay, Fed, the jobs market is okay. So now let's get over to the other big piece of this puzzle, the other culprit, inflation. Well, inflation is caused by oil. Remember, right before the war, we had mortgage rates at 5.99. And oil was like $65 a barrel. Then it ran to 120. Mortgage rates were on their way to 7%. And then they started coming down. Well, oil now is back down to basically where it was pre-war. But here's the problem. And I get this question a lot. So Dan, why aren't mortgage rates following? Well, here's the question you need to ask. Is Iran going to follow through and abide by all the rules? Well, if you say with 100% certainty, yes, well, then the interest rates are going to start to plummet. But if there's uncertainty there, the risk, well, then a lot of traders and people are going to say, we're just going to wait until we know Iran is actually going to stay with the plan. Because we know otherwise, well, the GDP is okay. It's at 2% and growing. We have an unemployment rate that's actually getting better. We have that pesky inflation that's mainly caused by oil. So now if you have oil kind of retreating, and now the jobs report's coming in saying, okay, maybe the Fed, you don't have to hike rates because the job market isn't as robust. What would the markets do? Well, they're going to rally. So we got the Dow Jones, the NASDAQ, and the S&P all once again, I think all hitting record highs again. You got oil coming down and you have interest rates on the 10-year treasury. It's just staying steady, and I'll get back to my bond here in a second. So now let's look over and say, okay, what's the Fed going to do? Because they're telling us, a lot of analysts are saying the Federal Reserve in 27 days, they're probably not going to do anything. But from there, they're going to continue to increase rates. Well, let's get to that chart in a second. I want to explain to you guys what I'm advising my clients, and then we'll go back to see what the Federal Reserve is going to say, and then we're going to end up with the chart to see where we start the day. So my expectations are, if you're a client of ours right now, we pre-approved you and you get a house under contract, we're locking you in. The reason being is a drone strike, the Strait of Hormuz closing. I know I repeat that all the time, but that's the culprit that caused rates to jump. So I don't know if that's going to happen, and that's why rates aren't plunging from here. So we're going to lock in. But if you're looking, okay, Dan, I'm going to buy in 3-4 months. In the fall, I'm looking to build. It'll be done at the end of the year. You're going to be okay. Do me two favors. One, watch oil. As oil moves lower in the Strait of Hormuz and Iran situation really gets solidified, you're going to see rates coming down. You're going to be okay. The other thing is subscribe to my channel. Every time I post a video, you'll get an alert. Hit that bell so make sure you do get an alert. But what do you do if you're a homeowner right now? You're like, Dan, okay, I know what I need to do if I'm buying a house now. I know what I need to do if I'm buying a house down the road, but I'm a homeowner. What do I do? Well, let's get over to this piece of the puzzle. I want you to go to my website. It's therateupdate.com. Put your information into right up through there. That's Rate Watch 2.2. I created this thing myself and I monitor this thing. What I want to track is your rate and your payment. So you can come in and say, Dan, when rates hit 599, call me, text me, email you. I'm going to track it and I'm going to call you. But you can also say, Dan, my house payment's $2,500. If I can save $200 a month, $300 a month, $500 a month, call me. Make sure I don't miss it this time. We'll do that. But you might be out there also saying, okay, how do I get the best rate? Dan, I don't really know what you do. And I get comments a lot of times down below. It's like, Dan, I already locked in. Well, I hope you used us, or at least got a quote from us. So here's what we do. My name's Dan Frio. I'm actually a licensed mortgage loan officer in all 50 states as well as Puerto Rico. The biggest thing is my slogan is one application, one credit pool. We're going to compare your loan with 30, almost 40 different lenders. Imagine doing that on your own. Okay, you put in your application there. That credit union, Bankrate.com, LendingTree sold my loan to 5 different places. They pulled my credit, ruined my credit. Everybody got back with me with a quote. I really don't know what to look at anyways. Well, upload the best one that you think into that loan estimate review. I'm going to have a video out to you within hours to show you, okay, if you're trying to pay off all your loans, here's what we can do. What kind of rate can we get you? What's our fees over here? What can we do for you? And if we can beat that other lender on rates and fees, I'm hoping to win you as a client. But you might be a homeowner out there saying, okay, Dan, I got this rate. It's really good, but I have a lot of debt. I just don't know what to do. I don't know if it's prudent to use my equity in my house. Well, folks, I'm not trying to put you in any more debt. I'm just trying to help you structure this. You might be trying to say, okay, Dan, I need to get out of debt, lower my payments, and just help, survive life. Or you might be one of those saying, okay, I hear these plans where I can pay off my house in under 10 years. We have all these plans for you. So click up through here, the debt analyzer. If you're really in debt right now and need some help, click that out. Otherwise, reach out to us. We'd love to help you out. I also have a lot of tools for you. They're all free, 100% free. Go to my Stand store down below. These are things out here that you ever try to find that calculator just to figure out what your mortgage payment is, and you got to go through all these hoops? Well, just go to this one. If you're looking to buy a house, your first house, second house, an investment property, investors with DSCR loans, bank statement loans, plug your information into here. This will actually guide you to the exact program that you need. You're a homeowner drowning in debt. Got this one through here. Just looking to refinance, see if it makes sense. Got through here, and there's more down through there. So I'd love to help you out. All these tools are free. Reach out to us. But what I like to do at the end of this video is go to the Federal Reserve. What are they expected to do in 27 days? They're expected to do nothing. The shocking thing is, remember yesterday, there was really nothing over here. Now there's a chance that the following meeting, they're going to increase rates. There's almost a 50% chance of that. Then we get into 2027, they're saying there's an increase there as well. I'm saying there's a 100% chance. Fed ain't doing anything. And if anything, in the next few meetings, maybe not this year, but soon, they're going to be cutting rates. So let's go back to the chart, see where it's ending in the day, and it's actually giving back a lot of this. So this isn't what I like, but it's a holiday weekend. There's limited trading. The markets aren't open tomorrow, so this might just flatline. But the good news is it's still green. That means mortgage rates, they might not get any better, but they're not going to get any worse. So hopefully now you understand a little bit more about what causes mortgage rates to move, the whys behind it, and if you need some help, now you know where to go as well. So thanks for watching. God bless. Have a fantastic holiday weekend. I'll be back here on Monday with the opening bell to let you know what's going on with these and the most important reasons behind it. Thanks for watching. God bless, folks. See you then. Bye-bye.